Silver just crossed $99. Gold is knocking on $50,000. And Wall Street is calling it a blow-off top. They said the same thing at $20, then at $40, then at $70. But here's what they don't understand. In 1979, silver moved 409% in just 1 year. If history repeats, and the pattern suggests it will, the current price isn't the peak. It's barely the beginning. Because when trust in currency collapses, the repricing doesn't happen slowly. It happens at the speed of collective realization. And right now, that realization is just starting to accelerate. Welcome to John Analyst. If you've been navigating markets for a few decades, you know that the most profitable insights often come disguised as controversy. This channel exists for those who prefer strategic clarity over mainstream consensus. If that resonates with you, consider subscribing. Think of it as bookmarking a resource you might need when the next market shift catches others off guard. And before we continue, where are you watching this from? Drop your location in the comments. It's always valuable to know where serious economic observers are positioned globally. Now, let's examine why silver is far from done and what's actually coming next. Friday, January 23rd, 2026, markets opened with silver trading at $99.90 per ounce, less than 10 cents away from a psychological milestone that seemed impossible just months ago. Gold sat at $49,443. Within striking distance of $50,000, these are not minor market movements. These are generational shifts in monetary perception. Yet the traditional finance community is calling this the end. A recent analysis from a credentialed financial analyst captured the prevailing sentiment perfectly. The observation was straightforward. Influencers claim silver's bull run hasn't even started, while simultaneously, silver appears to be in the middle of a blow-off top. The conclusion? Investor psychology is wild. The implication? Those who didn't buy at $20 are now irrationally buying at $93, expecting silver to reach $500 by the end of 2026. On the surface, this criticism seems reasonable. It follows the logic of traditional equity markets. It applies the frameworks taught in business schools. It reflects decades of experience analyzing corporate valuations. But it misses something fundamental. The analyst isn't wrong about investor psychology being wild, but the mistake lies in applying equity market psychology to monetary metals. These are not the same asset class. They don't move for the same reasons. They don't follow the same patterns. And most critically, they don't peak the same way. This disconnect reveals a broader issue within the financial analysis community. Precious metals operate under a completely different valuation framework than stocks, bonds, or real estate. When experienced equity analysts examine gold and silver, they instinctively apply the wrong tools. They measure productivity when they should measure trust. They look for earnings growth when they should track institutional credibility erosion. They expect diminishing returns when the actual pattern shows accelerating returns. This is not a criticism of their expertise. These are highly competent professionals who understand corporate finance deeply. But precious metals require a different lens entirely, one that most traditional analysts have never developed. Consider the typical equity investment thesis. An analyst examines a company's fundamentals: revenue growth, profit margins, competitive positioning, management quality, market opportunity. The valuation reflects the company's ability to generate future cash flows. When that ability improves, the stock rises. When it deteriorates, the stock falls. This makes intuitive sense. It's logical. It's measurable. Now consider the precious metals thesis. Silver and gold don't generate cash flows. They don't have earnings reports. They don't innovate products or expand into new markets. Their value doesn't derive from productivity. It derives from their role as monetary alternatives. When confidence in conventional currency systems deteriorates, this creates a completely inverted valuation dynamic. When institutions function well and currencies maintain credibility, precious metals underperform. They sit quietly in portfolios, generating no yield, serving primarily as insurance. But when trust begins to erode, when central banks expand balance sheets beyond sustainable levels, when government debt reaches levels that cannot be serviced through conventional means, when currency debasement accelerates, precious metals don't just rise linearly, they reprice violently. And here's the critical point that traditional analysts miss. This repricing doesn't happen early in the cycle. It happens late. With corporate equities, the largest percentage gains occur in the early stages. A startup can grow 1,000% in its first few years, but once that company reaches billion-dollar valuation, tripling in size becomes structurally difficult. The mathematics work against it. The market opportunity constrains it. The organizational complexity limits it. Precious metals work in reverse. The largest gains come toward the end of the bull cycle, not the beginning. This isn't speculation, it's historical pattern. The 1970s bull market in silver demonstrated this exactly. Returns accelerated as the cycle matured. The steepest gains occurred in the final phase, not the opening phase. The current cycle is following the identical pattern. Returns in 2025 exceeded returns in 2024. Returns in late 2025 exceeded returns in early 2025. And if the historical blueprint holds, returns in 2026 will exceed returns in 2025. This is not wild psychology. This is pattern recognition based on how monetary metals actually behave during currency crisis cycles. The traditional finance community sees $93 silver and assumes the move is exhausted. They're applying equity market logic to a monetary phenomenon, and that misapplication is causing them to miss what's actually unfolding. The bull market in silver is not ending. It's accelerating. There exists a pattern so consistent across corporate history that it has become an unspoken law of equity markets. Yet this same pattern, when applied to monetary metals, leads analysts into catastrophic misreading of price trajectories. The pattern is simple. Examine any major corporation's historical chart. Microsoft, Oracle, Cisco, Johnson & Johnson, Walmart, Coca-Cola, even Berkshire Hathaway. Despite operating in completely different industries, despite different business models, despite different competitive dynamics, they all share one unmistakable characteristic. The biggest returns came first. The smallest returns came later. Microsoft's early years saw exponential growth that would be mathematically impossible to replicate at its current scale. A garage operation doubling in value is unremarkable. A $3 trillion enterprise doubling in value would represent the largest wealth creation event in human history. The mathematics simply don't permit it. Oracle followed the identical trajectory. Explosive early growth, then moderation, then mature, steady returns. Cisco's chart tells the same story. The technology sector didn't invent this pattern. It merely exemplified it with particular clarity. But this extends far beyond technology. Johnson & Johnson, a healthcare conglomerate operating in one of the most stable industries, shows the same curve. Walmart, built on physical retail infrastructure, displays identical characteristics. Coca-Cola, selling the same product for over a century, cannot escape this fundamental law. Even Berkshire Hathaway, arguably the most successful capital allocation vehicle ever created, generated its largest percentage returns in its earliest decades. Warren Buffett himself has acknowledged that compounding enormous sums becomes progressively more difficult as the denominator expands. This makes perfect intuitive sense. A company with $10 million in revenue can realistically triple to $30 million within a year through operational excellence and market capture. A company with $10 billion in revenue cannot realistically triple to $30 billion in the same time frame. The constraints are physical: capital allocation, human coordination, supply chain development, market saturation, regulatory navigation. These are real-world limitations that cannot be overcome through willpower or strategy alone. Now observe what happens when this same analytical framework gets applied to precious metals. The 1970s silver bull market moved in the exact opposite direction. Early returns were modest. Mid-cycle returns were larger. Late-cycle returns were parabolic. The steepest part of the curve came last, not first. The slope didn't flatten over time. It steepened. The current bull market is replicating this pattern with precision. Silver's performance in early 2024 was solid but unremarkable. By late 2024, returns had accelerated. Throughout 2025, the acceleration continued. The first half of 2025 delivered strong gains. The second half delivered even stronger gains. By year-end, gold had returned 64%. Silver had returned 146%. And critically, the rate of increase itself increased as the year progressed. This is the exact inverse of corporate equity behavior. Why does this inversion occur? Because the valuation drivers are fundamentally different. Corporate valuations rise with productivity and fall with inefficiency. This creates natural constraints. Productivity improvements require time, capital, coordination, and innovation. These factors accumulate slowly. Therefore, valuations adjust slowly, with the largest adjustments occurring when the base is smallest. Monetary metal valuations rise as trust erodes and fall as confidence returns. Trust is not constrained by physical limitations. Trust operates at the speed of perception. And perception can shift instantaneously. Consider the boundaries. What limits how high a corporate stock can rise? Market size, competitive dynamics, regulatory environment, technological disruption, management execution. These are tangible, measurable constraints. What limits how high silver can rise? Human perception, fear, belief, institutional credibility. These are psychological constraints, and psychological constraints can evaporate overnight. This creates the third critical distinction: speed. Companies accrue value at the speed of human organization. Organizational change is slow. Building infrastructure takes time. Scaling operations takes time. Expanding market share takes time. Even with perfect execution, there are physical limits to how fast a company can grow. Monetary metals accrue value at the speed of collective realization. Realization happens at the speed of thought. If enough market participants simultaneously conclude that currency has lost credibility, silver reprices immediately, not over quarters, not over years, immediately. This explains what traditional analysts perceive as irrational behavior. If someone doesn't believe the dollar holds value, offering them $100 for an ounce of silver won't work. Offering $200 won't work either. Offering $300 still won't work. Because 300 units of something worthless isn't more valuable than 200 units of something worthless. The nominal price becomes irrelevant once trust collapses. This is why silver can move from $90 to $200 far faster than Microsoft can double its market capitalization. The constraints are entirely different. One is bounded by organizational physics. The other is bounded only by collective psychology. And collective psychology, once it shifts, moves with terrifying speed. Traditional finance sees current prices and applies corporate equity logic. They see diminishing returns ahead. They see unsustainable valuations. They see a blow-off top. They're looking at a monetary phenomenon through an equity lens, and that lens is showing them exactly the wrong picture. There's a moment in every currency crisis when the mathematics stop making sense to those still thinking in conventional terms. The numbers appear detached from reality. The movements seem irrational. The velocity feels unsustainable. This is not a breakdown of market logic. This is the market switching from one logic system to another, and that switch doesn't happen gradually. The year 2025 provided a perfect case study in how this acceleration mechanism actually functions. The data tells a story that contradicts everything traditional equity analysis would predict. First half of 2025, gold and silver posted respectable gains, strong performance by historical standards, the kind of returns that would satisfy most portfolio managers, solid, predictable, contained within reasonable expectations. Then something shifted in the second half. The returns didn't just continue, they accelerated, not marginally, significantly. Gold didn't maintain its first half pace, it exceeded it. Silver didn't plateau, it intensified. By year end, gold had delivered 64% annual returns. Silver had delivered 146%. But here's what matters most. The second half outperformed the first half. Within a single calendar year, the rate of increase itself increased. This is the signature of monetary acceleration, not equity appreciation. If silver were behaving like a corporate stock, the opposite would have occurred. Early gains would have been largest. Later gains would have moderated as the price base expanded. The percentage returns would have compressed as the absolute price rose. Instead, the percentage returns expanded as the absolute price rose. This is mathematically impossible in productivity-driven assets. But it's entirely normal in trust-driven assets. The mechanism works like this. Monetary metals don't rise because of production improvements or operational efficiency. They rise because confidence in alternative stores of value deteriorates. And confidence doesn't deteriorate linearly. It erodes slowly at first, then rapidly. Think of it as a dam developing cracks. The first crack changes the structural integrity by a small margin. Water seeps through slowly. The dam still functions. Most observers don't notice the problem. Those who do notice assume the crack can be patched, but each crack weakens the surrounding structure. The second crack appears faster than the first. The third crack appears faster than the second. Then the deterioration accelerates exponentially. The dam doesn't fail gradually, it fails catastrophically. Currency confidence follows the same pattern. Early in the cycle, most market participants maintain faith in the system. They acknowledge problems, but assume those problems are manageable. Central banks can control inflation. Governments can manage debt. Institutions remain credible. The cracks are visible, but not yet critical. As the cycle progresses, more participants begin questioning those assumptions. Not everyone, not even most people, but enough to start shifting capital positioning. This creates the first wave of monetary metal appreciation, steady, measurable, rational. Then the second wave begins. The participants who initially dismissed the concerns start recognizing the pattern. They see the cracks expanding. They observe the institutional responses failing to contain the pressure. They watch the early movers profiting from positions taken when metals were cheaper, and they begin repositioning their own capital. This is where acceleration starts becoming visible. The third wave is different. This is when collective realization reaches critical mass. The dam isn't just cracked anymore, it's visibly failing, and everyone can see it simultaneously. Capital doesn't flow into precious metals gradually at this stage, it floods. This is the phase where metals reprice at the speed of thought, because once enough participants conclude that currency has lost credibility, the price of the alternative doesn't matter anymore. Someone who believes the dollar is fundamentally impaired will exchange dollars for silver at $93 per ounce. That same person will make the identical exchange at $150 per ounce, or $200, or $300. The nominal price becomes irrelevant because the calculation isn't about price anymore. It's about relative trust. And when trust in one asset has collapsed, the price of the alternative becomes almost meaningless. This explains why silver can move from $20 to $93, and then from $93 to several $100s, in a time frame that seems absurd to equity analysts. Equity analysts are measuring productivity constraints, but there are no productivity constraints operating here. The only constraint is perception, and perception can shift completely in days, sometimes hours. The 2025 acceleration wasn't an anomaly. It was confirmation that the mechanism is functioning exactly as the historical pattern suggests it should. Returns increased as the cycle matured. The slope steepened rather than flattening. The mathematics inverted relative to equity market expectations. And if the pattern holds, if history continues repeating with a precision it has demonstrated so far, then 2026 won't simply match 2025's returns. It will exceed them. Because the acceleration mechanism doesn't stop mid-cycle. It intensifies until the cycle completes. The largest moves don't come at the beginning. They don't even come in the middle. They come at the end. And the data suggests we're not at the end yet. We're entering the phase where the acceleration becomes undeniable, where the repricing moves beyond what conventional analysis considers possible, where the speed of collective realization overwhelms the frameworks designed to contain it. The dam isn't holding anymore. The cracks aren't theoretical. And the flood is just beginning. When analysts dismiss $500 silver as irrational exuberance, they reveal something important. They're operating without a reference point. They have no framework for what a mature, precious metals bull market actually looks like. They've never studied one. They've never lived through one. And they certainly haven't modeled one, but there is a blueprint. And it's not hypothetical. January 22nd, 1979. Silver closed at $6 per ounce. Unremarkable. Quiet. Most market participants weren't paying attention. Those who owned silver held it as a minor portfolio hedge, nothing more. The price had been relatively stable for years. There was no panic, no mania, no front-page headlines. Then the mechanism activated. By December 31st of that same year, less than 12 months later, silver closed at $32.20 per ounce, a 409% return in a single calendar year, not a decade, not even multiple years, 1 year. This wasn't a technical glitch. It wasn't market manipulation. It wasn't a short squeeze, though that contributed to the final spike. It was the natural result of collective realization reaching critical mass during a currency confidence crisis. Now apply that same historical return to the current cycle. January 22nd, 2026. Silver closed at $96.83. If the 2026 cycle replicates the 1979 return, if history repeats with the same 409% annual gain, silver doesn't need to reach some fantasy number pulled from speculative fever dreams. It reaches $492 per ounce by year end. Not $500, $492. Almost exactly what the so-called irrational speculators are predicting. Except they're not speculating, they're pattern matching. They're applying the only reliable historical data point available. They're assuming that human behavior under currency stress follows recognizable patterns. And those patterns suggest the current price isn't extended. It's early. Here's what makes this particularly significant. The 1979 move happened in an analog world. Information traveled slowly. Market access was limited. Coordination was difficult. Capital flows were constrained by geographic and technological barriers. Despite all those limitations, despite the friction in the system, silver still moved 409% in 12 months. The current cycle operates in a digital world. Information travels instantaneously. Market access is universal. Coordination happens in real time across global networks. Capital flows face almost zero friction. If collective realization occurs now, the repricing won't be slower than 1979. It will be faster. This is the part that traditional analysts cannot process. They see $93 silver and think the move is exhausted. They watch buyers entering at these levels and assume irrationality. They compare current prices to the $20 level from earlier in the cycle and conclude that anyone buying now has missed the opportunity. But they're measuring from the wrong baseline. They're comparing current prices to past prices within the same cycle. That's equity market thinking. In equity markets, buying after a 400% move usually means you've missed the primary appreciation. In monetary metals, buying after a 400% move often means you're still positioned before the primary acceleration. Because the largest move comes last. Consider the psychology at each price level. At $20, silver was boring. Institutional investors ignored it. Retail investors saw no urgency. The financial media rarely mentioned it. There was no collective realization, just a small group of contrarians accumulating quietly. At $50, awareness increased. Some momentum traders entered. A few financial commentators started paying attention. But the mainstream narrative remained skeptical. Most participants still viewed it as a speculative commodity, not a monetary phenomenon. At $93, the dynamic shifts. Now it's unavoidable. Media coverage intensifies. Institutional research departments scramble to explain what's happening. Retail investors who ignored it at $20 suddenly feel urgency. The participants who mocked precious metals holders now face uncomfortable questions about why they missed the move. This is when collective realization accelerates, not because of fundamentals changing. The fundamentals were visible at $20, but because human psychology requires undeniable proof before shifting deeply held beliefs. And $93 silver provides that proof in a way $20 silver never could. So the question isn't whether $500 silver is rational. The question is whether the conditions that drove silver 409% in 1979 are present today. And by every meaningful measure, they are. Currency debasement is accelerating, not slowing. Central bank balance sheets continue expanding. Government debt levels have reached points that cannot be serviced through conventional means. Institutional credibility is eroding across multiple domains. Simultaneously, the trust mechanism that holds currency systems together is fracturing. These aren't predictions. These are observable conditions. And under these conditions, monetary metals don't appreciate modestly. They reprice violently. The traditional finance community sees this and calls it wild psychology. They dismiss the $500 target as delusional. They assume anyone buying at current levels is chasing a top. But those assumptions rest on applying corporate equity frameworks to a monetary crisis. And that application fails every time. The people who didn't buy silver at $20 had their reasons. Those reasons seemed rational at the time. The people who aren't buying at $93 have their reasons too, and those reasons will seem equally rational, right up until silver crosses $200, then $300, then $400. And at each level, the same analysts will insist the move is exhausted. The same critics will mock the buyers. The same frameworks will predict imminent reversal, because they're still measuring productivity when they should be measuring trust. They're still expecting diminishing returns when the pattern shows accelerating returns. They're still analyzing a monetary phenomenon through an equity lens. History doesn't repeat exactly, but it does follow patterns. And the pattern from 1979 isn't some distant anomaly. It's the blueprint for how monetary metals behave when currency confidence collapses. Silver isn't done. It's not even close. The acceleration is just beginning.